All right, all right. Okay. Welcome guys. A minute or so late, but it's all good. It's Sunday evening, 8 o'clock. Thank you so much for joining me. I know that there's a number of you in here already. Yeah, so this is another live session. I've got Ralik on in the backstage. We're going to talk a little bit about the markets generally. There's a little bit of news, CPI data. We were talking about this before we actually went live. I think that it's worthwhile us mentioning that because if you're looking at portfolios at the moment, we might see a bit of a bumpy ride tomorrow and through next week as a result of this. So, yeah, we'll be taking questions as we normally do. I'm just looking at the comments right now. Food dwellers here. Welcome, Ian, Abdul. How you doing, mate? I'm very, very well, thank you. PM, thank you so much for being here. Michael, thanks for your advice on Thursday. All good, mate. Hopefully it was helpful. Ivan, all of you guys are here. So as people kind of arrive, we'll start to take a few more questions. Couple of things from me, and I have to remember to do this because I always forget. So, issue 2 of the magazine is now out. It went out over the weekend to everyone who is subscribed. If you are not subscribed already, you can actually go and read issue 2. And this is how unorganized I am because I will show you how it basically works and how you can actually read the second issue of the magazine. Now, a lot of what we cover in the second issue of the magazine is pertinent to what's going on in the markets right now. So there's a lot of conversations in and around inflation, the perfect storm, what's going on with the markets, what's happened with crypto. Ralik's actually contributed to the crypto column and stuff like that as well. I'm going to show you very, very quickly. This is the website. So the magazine is called The Convo. And the website for it is theconvo.io. So if you go onto this website right here, you will be able to read the magazine if you go onto this one right here. So you click on issue 2 and you'll be able to read through the columns and everything that we've got here. So quantitative easing sounded like a really suitable term to kind of like debunk and break down, because when we talk about where we are right now with inflation and interest rate hikes and all that kind of stuff, many people argue that quantitative easing is one of the reasons why we're actually at this point. So debunking that in terms of vocabulary and jargon and financial terminology, I thought would be useful. We talk about the inflation's perfect storm there. Maybe some things for you to do. I cover a piece on Invest Engine. We talking about the Fed. So Jerome Powell, who is he? He's probably the most powerful guy in the United States outside of Joe Biden, because he heads up the most powerful institution really in the United States. So we have a little bit of coverage on him, a little bit of our mission on here, best savings accounts. There's a really nice conversation I had here, which was actually inspired by Callum, who emailed me 3 or 4 weeks ago. Really good thing to read there. Then Ralik talks about crypto's battle with the Fed, and we have some other bits and pieces in there as well. So if you do want to go and read the issue, you can literally do that by heading over to theconvo.io. It is free, but if you subscribe at the top of that page, you will get an email every single time the issue comes out. So knock yourselves out, guys. Hopefully you'll enjoy it as well. All right. Okay. So there's a few comments and questions coming in here, but before we jump into any of that, let's I just want to bring in Ralik actually because we're having a really good conversation and there's a few things that I think you guys might actually benefit from in conversation. Then we can get into the questions properly. Dude, how's it going?
Hey Pete, it's going well. How about yourself?
I'm not bad, mate. Not bad at all. Not bad at all. It's another Sunday, so another week. I'm clear from COVID for the first time in a week. Yesterday, I actually went out of the house, so
Oh,
it felt
nice.
like it felt like I had a. It's what you must feel like if you've been in prison and you're finally allowed out into the open world. I felt a little bit like that. So yeah, all good. But how are you?
It's all right. It's all right. Been a bit of a volatile week, but otherwise, I mean, I think the week to come is gonna have quite a lot of answers to many of our questions that we have been asking about the conclusion to what the Fed's going to do, if there is going to be any immediate action, as well as who knows? Maybe we get some news as to what's going on in with the whole Russia-Ukraine situation too.
Yeah, absolutely. So before we started, before we went live, I missed this, but I did. I was reading about the emergency Fed meeting tomorrow morning, and when you said that the CPI numbers were really, really bad in the States, um, it kind of made sense while I was then reading about the emergency Fed meeting tomorrow on Monday. So just talk through what the CPI number. So for everyone who doesn't understand what CPI is, it's basically a measure of inflation. So remember, here in the UK and in the States, the target for inflation is 2%. So at the moment, the UK is at 5.4. The US is quite significantly above that, isn't it?
Yeah, so the figures came out last week, and it's looking like it's about 7.5% CPI inflation, which is ridiculously high. It's a lot higher than anyone was really expecting. And also based off of the last Fed meeting that we did have, which essentially caused this significant drop that we experienced over the last couple of weeks. Um, it came across, especially from Jerome, that it's looking like they're leaving everything on the table, where they're
Hmm.
not committing to anything right now, and it's more about, okay, they were planning to have the meeting and the announcement with regards to the interest rate hikes in March. The expectation there was a 25 basis point hike in the inflation figures, but now with the massive spike to 7.5% inflation, it's looking like they either might need to do additional hikes throughout the year, or increase that from, say, a 25 basis point hike to maybe a 50 basis point hike.
Hmm.
Personally, I don't think they're going to go with the 50 basis point hike. I think that's a little bit extreme too quickly. And it's more likely that if they are going to act out of the initial plan, it's more likely going to come in maybe 4 to 5 interest rate hikes instead of the planned three that we were all expecting.
It's interesting, really, because yeah, when he spoke on December 26th, he was very, I guess, non-committal around what those interest rate hikes might be, and everyone is expecting it to be about 0.25%, but he wouldn't rule out it could be more if it needs to be more. And I'm surprised at the job numbers, because apparently the job numbers were really, really well better than they thought they were going to be. But you talk about job numbers and then the rate of inflation, like those two things. Yes, all right, you can talk about the fact they might actually impact one another, but the job numbers are not going to have an immediate impact on inflation. The job numbers are kind of more of job created and therefore economic outlook, as opposed to the immediate problem with inflation right now as we currently see it. And so tomorrow, when they do meet for an emergency meeting, do you think it is likely that they'll press the button on an interest rate hike early and start that process a bit earlier and just not wait until March 16th?
Well, that's the $1 million question right now, isn't it?
Mm,
I mean, it's whether they're actually going to proceed with that or not, and that's also why I think it's important to not overreact to these kinds of events, and instead be level-headed when going into an announcement like this and an emergency meeting like this. I think it is likely that they will maybe speak about an additional 1 or 2 interest rate hikes throughout the year. Um, which would likely bring the markets down. But it could also be argued that that's kind of been factored in already with the massive drop that we saw in the US markets over the past 2 days. I believe like Nasdaq was down about 3% yesterday. I mean on Friday, and there was quite a large swing on the day of the news too. So it all comes down to what that decision is, and being prepared for whichever way it does swing. Personally, I'm sort of sitting where I've set myself up for for potential additional hikes, and then I just need to act a little bit further. And then on the other side of it as well, if say they come out and nothing really comes of it, then I'm also in a position to sort of close out those hedge positions too, to take back more of a bullish approach. So it all kind of depends what does happen in that meeting. I believe it's happening at about around 11:30 a.m. I think, is it PST or EST?
I think it's
That's I think it's
EST.
called
I think it's EST. I
EST. Yeah,
think I always get those two things confused. So
yeah.
yeah,
Me too. Me too.
yeah.
So we're just gonna have to sort of see how it does go. I'm likely going to live stream the event and um, wait for that announcement, just so that I can actually sort of speak copiers through the implications of whatever does get decided at the end of the day too.
hmm Do you think that there's going to be a reaction within the crypto market itself? Because we've just seen kind of Bitcoin kind of take a little bit of a bump back up. Do you think this is likely to
Yeah,
upset things?
definitely. So it's an unfortunate thing right now is crypto is very much tied to the events that are taking place right now. We saw that a couple weeks ago with the initial drops, and then as we were starting to see a little bit of a breakaway, which I also spoke about in issue 2 as well.
hmm
We saw a breakaway from crypto and stocks, where stocks were relatively flat and crypto was spiking back up. And we had Bitcoin break 45K, and it was looking like it was going to continue to push higher back towards the 50K levels. And then unfortunately, in the next like hour or two after it made that breakthrough, then we had the inflation figures come out, which just sent everything straight back below those lines. So
hmm
it is one of those things where yes, it does impact the crypto market in a relatively large way, but I would expect crypto to recover probably a lot faster than stocks would once everything calms down, which is kind of what we saw in the past week when we did have that initial spike back above 40K. That separation from crypto and stocks, where yes, the inflation and the interest rate news is going to negatively impact it. It is also likely to bounce back a lot quicker once the dust does settle over there.
Yeah, fingers crossed. I just think ultimately for most people, if you're in the markets at the moment, just know for a fact that things are going to be volatile. Like we can't control anything that is going to happen. Really, to be fair, we're kind of, and this is why I often say to people that it's almost like a roller coaster, right? You just gotta strap in and try to enjoy the ride as much as you possibly can. There's a lot of stuff that we can't control. So, as long as you're, I guess, as comfortable with the positions that you currently hold, that's one of the key things. Trying to be as comfortable with the positions that you currently hold, and yeah, and just enjoy the ride really, and not overextend yourself more than anything else. I would say. I mean, would you add anything to that at all?
I think you pretty much hit it on the head. It's just like being cautious right now, not going too crazy, and also having a plan. I think it's so important to have a plan where there's and this is something I addressed on my feed a few weeks ago actually, and it's something I do want to like start to speak more about. Is there's a massive difference between doing nothing out of ignorance and then doing nothing as a strategy. So
hmm
those are two completely different things.
hmm
If you see the markets take a dip and believe that there's not really any justification for that drop and you expect an increase, then sort of holding is a valid strategy. But if you don't really know what's going on, and the markets just keep dipping, and you're like, okay, well, I'm just going to hold until it goes green, I would say that's not a very good strategy. You need to understand the events that are taking place to cause that drop in the first place. And an event like this, it isn't one of those events where we can just sit back and do nothing. Um, I think you're gonna get hurt in the short term if, say, there are additional interest rate hikes like 4 or 5 in the year, or we get much greater interest rate hikes. If you're sitting there just sort of doing nothing, not really prepared for it, it is highly likely that it will recover at some point and you'll get back to where you should be. But there's a lot of power too in making sure that you're hedged, or sort of just deleveraging some of that risk that you do have by not being overexposed to certain industries and sectors.
Yeah, I think that's a really solid point. And I kind of mentioned that I mentioned it last week on the podcast, and I mentioned it briefly in the newsletter. It's really, really important for you to be able to have a look at the circumstances that you're in right now, try and make sense of it, and then base your move off that. because it's all about an informed decision. And this is, I guess, where it's important for people to understand the mechanics of how these things kind of work in order to make a decision, particularly if, like many people, you're holding individual stocks and you've only just started out, or you've just gone into cryptos and you've only just started out. Understanding the context of the environment so that you can make a call is really, really important, because otherwise, yeah, you could end up pretty much just doing nothing and then realize that you should have acted a little bit sooner. And it's always very, very tricky. It's difficult in terms of a balance to get right. But yeah, this is where knowledge is power, really, to be fair. So
For sure, for sure. I mean, sort of an example I can give as well, because I think sometimes it is good to actually sort of have those real life examples. Is if you sort of look at like a balanced, relatively well balanced portfolio with say stocks and cryptos, events like this generally, I'd be more focused on the stock portion of the portfolio and making sure like that you're not overexposed to say US markets. Whereas something like crypto, the industry as a whole does look like it's in a relatively good place. So it might be a valid strategy to say buy and hold and actually just not try and say short the markets or do anything too crazy there. Because if there's one thing I've learned about my time in crypto, it's you don't want to short those markets if you don't know what you're doing. It can lead to very quick liquidations.
absolutely. Cool. All right. So there are quite a few comments in here at the moment. So let me just have a look and see if we can. I'm just going to see where the questions actually begin, and try and get to the first one first. Okay, cool. This is a hello. Okay, cool. I've got the first one here. Okay. So, let me find it on this feed, because this is the feed where I can actually pop it on the screen. Pete, so this is from Ian. I'm about to retire around Christmas time after 30 years as a paramedic. I have my lump sum, but more importantly, have around 1,000 to invest each month, but wondering best way to diversify funds. Okay, interesting. Uh, Retiring after 30 years as a paramedic, I have my lump sum. So I'm guessing they've taken, Ian, you've taken your pension commencement lump sum. Is that what you're referring to there? But you've got £1,000 to invest each month. Best way to diversify funds. Right. So, I mean, for me, there's a couple of things here, really, to be honest. Number one, your experience. I don't know how experienced you are in terms of actually investing, doing these things yourself. The first question I'll be asking is, are you comfortable with, looking at funds or picking funds on your own? Would you understand the language? If you do, then the simple way to really diversify, so you're not overexposed to one kind of like market, would be to have a look at a global approach more than anything else, and try and spread it as wide as possible. How you go about doing that, though, will be dependent on the provider that you try to access, so on and so forth, whether you're happy with picking it yourself or whether you would just prefer to actually go and outsource it to somebody else. And this is, especially in times like this where there's a lot of uncertainty around the corner. These inflation numbers we're talking about here, we can't control any of that. So to a certain extent, you're getting into the markets at the mercy of the markets. And so do you feel confident in picking what you feel you're going to be 100% okay with, bearing in mind that you're going to be putting £1,000 a month into this thing? Or would you prefer to maybe just outsource this to somebody else or to a company that will do all of the research and all of that management and all of that stuff on your behalf? Those are the two key questions really to ask yourself. And what you do will be dependent on what outcome and what action you decide to take. Because the greatest thing here is, yes, for this may be an opportunity with volatile markets to get in and maybe get some discounts on some companies. But the reality is we don't know how far this is going to go down. So it's like, are we at the beginning of it? Is it going to get a lot more painful? Are things going to even out, even if we do see, 4 or 5 interest rates over the next 12 to 18 months? Will things through that period of time even out, and will we get to kind of some kind of plateau? We don't really know at this point. So there's a lot of uncertainty. So it's being prepared for the uncertainty and trying to put your best foot forward. So are you okay picking it yourself? I guess is the first question. If yes, then maybe have a look at some global approach. That's probably where I would begin. And again, this isn't financial advice. You've got to do what you feel is right for you. But I would be thinking about taking a global approach so that you're not overexposed into any particular one area. And then if you're not comfortable with picking it yourself and managing it yourself and looking it after yourself, then I would be looking at using a provider that will do all of that work for you so that you don't have to worry about what happens with the markets and your investment values. It's outsourced. You give the responsibility to somebody else. I guess that would be my stance looking at it. I don't know. Would you add anything, Ralik?
I probably don't have much more I could add on that, to be honest.
Yeah. Cool. So let's have a look at this. Okay, this is a HL question. Hi Pete, hope you're good. Please explain what dealing fee is in HL to invest ETFs is 11.95. I don't understand it. So essentially, if you buy any funds or ETFs or anything like that, or you buy shares, they have a dealing fee, which is basically they charge you to carry out that action of you purchasing something with them. It's 11.95. It's a bit expensive, to be fair, but Hargreaves Lansdown do have a really good service in terms of the other things that they give you, newsletters, all this kind of stuff, like insights. They'll send you like information about any new IPOs or any new funds and those kind of things. They're okay. They're great, actually, to be fair, if you like that kind of information. But many people will have a look at 11.95 and think that's way too much, particularly if you only invest in sort of relatively small amounts each time. It can be very, very expensive. So yeah, that's essentially what the 11.95 is. It's a fee to execute a trade for you, pretty much. Right, do you actually want to stick around with this, or should I bring you in if there's any crypto questions that come up?
I think there's one crypto question, so we could always address that, and
Where
then
where is
I
it?
can
Where is it?
hop out. So Food Dweller asked, "Is HBAR crypto good to buy?"
I think I saw that. Here we go. There we go. This one right here.
Yeah. So yeah, the question with regards to HBAR or Hedera, it's an interesting one because Hedera doesn't actually use traditional blockchain. Instead, they use what they call a gossip protocol, which essentially is a way for the nodes to communicate without communicating all of the information. So it's sort of communicating some of the transactions, and then through that being able to validate the overall transaction. I don't personally own any Hedera, and my main reason for that is it kind of, I don't want to say it goes against the ethos of like what cryptocurrency is meant to be about, but it's, for me, it's more of a case study type crypto where it's like, does this have the potential to be something that's massive and used one day? I'm not sure. The other thing you also need to keep in mind is it's pretty much centralized by an organization, so it doesn't have that decentralized aspect. But from what we have been able to see, it does look solid with solid development and so forth on it. So I don't want to say like, yes, it's a good crypto, or no, it's not a good crypto. I personally have chosen not to invest in it because it doesn't have that decentralized aspect to it, as well as it's not really your traditional blockchain, which is what 99% of crypto is based on at the moment. So that's sort of my take. It is very, very interesting though. So if anyone isn't paying attention to Hedera, it's definitely one of those projects to actually keep an eye on as a whole, because who knows, maybe it can path the way to something new and additional developments within the space.
Awesome. That's great for that. Cheers for that. Because I wouldn't have been able to answer that with that kind of insight as well. So should I bring you back on if there's any other crypto questions that come through?
Yeah, that sounds good.
Cool, man. Cheers, Relic.
Shocking.
All right. Okay, cool. So I'm just trying to set up something in the background here. So bear with me just 1 second. It should work. And for some reason, it's just gone really, really weird for me because I just want to be able to actually maybe draw out a couple of scenarios for you if need be. So I just want to make sure that this actually works so that I can actually do that. I'll do this in the background in a moment. Right, let's have a look. I'm just going to go back up to the first bit of question. I know that Ian, you came back and said you're 57 when you're looking to retire. You don't know whether that actually helps. So, yeah, I mean, without knowing your full situation, mate. I mean, I would imagine with the paramedic, I'm guessing you're going to have like a final salary pension of some kind, um, and so I think a final salary is going to give you a guaranteed level of income for life. So you're not going to have to worry so much about the longevity of your pension or your income, if that makes any sense, because that is a big challenge for a lot of people. The challenge is, okay, so if you retire at 57 and your life expectancy is for another 30 years to 87, most people worry about ensuring that they have enough in their pension pot to last them for that 30 years, particularly if you're going to need something in the region of between 20,000 to 25,000 per year. So you do that by simple maths. 20,000 a year over 30 years is 600,000 pounds essentially in a pot. If you have a defined benefit, you don't have to worry about that because it's going to guarantee you a level of income for life. And so when you combine that with things like your state pension, that actually adds up quite a bit. And our state pension is probably around about just over £9,000 or something like that. So when you combine your state pension alongside whatever amount you're getting in your workplace pension, a defined benefit scheme, most people with a defined benefit scheme are generally going to be okay in retirement, especially with 30 years worth of services. You've had it right there. I guess the £1,000 that you're going to have there will be additional money. But again, it's all about the level of risk that you're willing and able to take. Now, I don't know what that equation is going to look like for you, mate, because obviously if you do have a DB, you've got a state pension. If you're married, you've got a partner. I mean, state pension won't kick in until much, much later on, mind you. But you're going to have enough. Well, you should have enough in income in theory, essentially. So if you're looking at investing £1,000, again, it's all going to be about your goals. Are you looking to invest it to supplement income at some point? That I don't know. Um, are you looking to invest it for a particular reason? Your goals and how long you have to invest it for will dictate really what you should be doing. And again, some of the stuff that I mentioned earlier in terms of maybe having a look at a global approach will be absolutely key because you don't want to be looking at too risky assets, and you have to be okay and understanding of where you are on the risk spectrum based on why you're investing that money. So yeah, I mean, there's quite a few things there. Without knowing the detail of it, it's hard for me to really give you like specifics, and I can't in a forum like this. But hopefully that's helped a little bit as well. All right, there is a question here from Naim. Naim, welcome, mate. Uh, I really want to get this thing to work. I've been fiddling around with this for the last 10 minutes or so. I want to be able to scribe for you guys and draw some of these things out, but it is having a bit of a temper tantrum right now, not wanting to work. So let's get to the message, the question from Naeem, and let's see what he has to say here. All right. So, thanks for the Convo newsletter. Quite easy to read and understand. Useful with a great user friendly. Hopefully, you recover from COVID. Yes, mate. I'm feeling much better. Thank you. Yeah, I managed to get up for the first time in like a week yesterday, so I feel like a brand new person person, to be honest. So yeah, thanks, mate. Like the stream, guys. Thank you very much. Really appreciate that. There is a question from Naeem here. My relative asked, is it worth contributing more to my workplace pension to gain increased returns? How does tax work on pensions? Example, having built approximately £100,000 pension pot. Thanks. Okay. This will be really good for me to be able to scribe this out for you. So if they're in a workplace pension scheme, a couple of key things for them to kind of be mindful of. So within your workplace pension, auto enrollment now means that your employer has to pay in on your behalf. So essentially, there's free money on the table. So I would often say to people, think about it this way: you want to try and maximize the maximum amount of free money you can get from your employer. So if you're contributing into workplace pension already and you want to maximize the potential for that pot of money whilst you're still working with that employer, then I would try to see if you can max out your contributions within your workplace scheme, particularly if they have a matching scheme in place. So a matching scheme is essentially where under auto enrollment currently, you have to pay in 3%. Your employer has to pay in 3% of your annual salary, qualifying salary. Then you have to pay in 5% of your qualifying salary. Now, that's 8% altogether. Now, with a matching scheme, some employers will say, well, if you go up to 10%, we will go up from 3 to 10% and match you at that point. That's more free money on the table. So if you're able to do that, that's always preferable because you don't want to say goodbye to free money. Utilize it, get it whilst you can. That's always the great thing. Now, the tax on pension is interesting because you get tax relief on the way in. So how it works basically is for every £100 that you pay in, to keep the numbers simple, you'll get £25 free from the government added to that. So essentially, for every £100 you pay in, your contribution essentially is 75 quid. Now, with a pension, that's your tax relief on the way in to the pension. When you hit 55 under current legislation, you can take a quarter of whatever you've built in that pension pot completely tax free. I'd really love to be able to draw this out for you guys. And it's just not working. But you are able to take a quarter of what you amass in your pension pot completely tax free. So in this example, £100,000. Okay. So if your relative was 55 years old today, they will be able to take £25,000 under current legislation from that £100,000 pot, receive that completely tax free. Now they can do with that money whatever they wish. So if they wanted to go buy a property or pay off debt or clear their mortgage, they can do whatever they want for that. So that's completely tax free. Obviously, when you're thinking about it from an income point of view, because you've taken 25% tax free, the remaining 75,000 is what you're going to then generate an income from. So when you look at it from a numbers point of view, had you not taken the 25 grand tax free, the level of income you would have been able to draw would have been higher on the higher amount. It will be reduced if you take your tax free cash of 25 grand. Okay. So, because the income will be based on £75,000 essentially. Okay. So that's really, really important to know. But when you start to take income from your pension, you will have to pay income tax on your pensionable income. So really, really important. That's a very, very high level whistle tour kind of like stop of just the general overview. But I'll just say to you, kind of like your cousin, if there's free money on the table that they can identify, any matching schemes or anything like that, then by all means, try and make sure that they're able to max out their contributions if there's free money still on the table from an employer, because it really, really does count in the long run. And that money can really make a huge, huge difference. I finally got it to work after all of that. Let's have a look. 1 second. Is it working? Did it work? What am I? I don't want it on there. I want the camera. Okay, I don't think it will work. Let's power through these anyway. Question about Life Strategy 100. Okay. I'm just gonna. Okay, here we go. What are they rebalancing? The different funds in the LS 100. Is there any similar fund, but more worldwide focus, more diversified than that much weighing on the UK economy? The Life Strategy 100 is a global. It's a global fund. I think I did this a few weeks ago. A lot of people think that it's UK heavy. It's not. It's not UK heavy at all. let's have a look at this actually. Because when you look at the makeup of it, it's not UK heavy. It does have UK exposure, but it's not overly UK heavy at all. Let me get this screen on. Okay. So, right, here we go then. So, this is the Vanguard site, right? So, I've just hopped onto the Life Strategy Funding. Let me just pull this out so it fills the screen for you guys. So, this is Life Strategy here. So, it's a fund of a fund, right? So, within this fund, there are other funds within it. But when you go to the portfolio data, what you're seeing here is, okay, so you've got the FTSE UK All Share Index, right? You've got US equity, so that's 19.4% there. You've got developed world in here, which excludes the UK. You've got the S&P 500, so that's US, that's 15.6%, right? Then you've got emerging markets, you've got developed world, you're excluding the UK. So these two here have no UK exposure whatsoever. So at the minute, you've got 19.7% in the UK. Just because it's top doesn't mean that it's UK heavy. You've got to look at the entire thing. Then you've got the FTSE 100, obviously 4.7, so that's UK. You've got Japan, you've got Pacific, you've got the FTSE 50 as well. You've got 1% there. But I would say, in my opinion, this is US heavy because you've got 19.4% in the US here. You've got another 15.6% there. So what is that? That's nigh on over 40%, really, in the US. So because it's top doesn't mean that it's UK heavy. It isn't. This is a US heavy global fund of funds essentially. Yes, and you do have the FTSE, but it's globally diversified and it's globally spread. So it's not a UK, sorry, heavy fund. It's not. It's just that it's got one of the highest weightings in terms of the UK all share at the top, but you've got the US contingent backing up there. Let's have a look at the second part of, I think, what you were asking here. What are they rebalancing? Well, this one is a 100% equity. So if you just go back out here, typically what you have is you have the others that will have bonds and stuff. So they would typically move into bonds and stuff like that. This is 100% equity. I don't necessarily know that they actually lifestyle out of equities into bonds, because the makeup and the objective is for it to be 100% into bonds. So they might rebalance. I mean, bearing in mind, what's this? This is a passive approach, right? So let me just see if I can find this in the objectives here. What's the style? I'm pretty sure this is a passive, so they wouldn't be rebalancing anything as far as I'm aware. Yeah, so the fund attempts to remain fully invested and hold small amounts of cash, except in extraordinary markets, political or similar conditions where the fund may temporarily depart from its investment policy. So this isn't going to be rebalancing really per se. As far as I'm aware, this will be a question really for Vanguard, because I'm not really too sure that there would be rebalancing at all. But this is a globally diversified fund of fund that has a great weighting towards the US first. All right. There was a question here from James. Right, bear me 1 second, guys, because I think I saw. Oh, Ian, thank you so much for that super chat, mate. I really do appreciate it. Thank you. Yeah, I really do appreciate it. Thank you very much indeed. Right, there was a question here from James. Right, let me just get rid of this screen share. Let's get rid of that. Okay, so James is asking, hypothetically, if you had maxed out your ISA allowance and pension contributions for the tax year with carryover, what tax-efficient investments might you look at next? Debating LISA, whiskey. Okay, so if you've maxed out your ISA allowance, so bearing in mind your ISA allowance will include your things like lifetime ISAs, right? So that's one thing. So when you say that, I'm assuming that you've maxed out your full £20,000, which means that if you have, and you haven't used the lifetime ISA, you can't use a lifetime ISA, if that makes sense. So your ISA allowance is 20 grand. So if you've used your full 20 grand, you won't have anything left for a lifetime ISA, because your lifetime ISA allowance is £4,000, but that is included in the £20,000 allowance that you get. So if you've maxed out your £20,000 allowance for your ISAs completely, but you didn't put it in an ISA, into a LISA, you can't do a LISA because you've maxed out. You've used your full allowance. In terms of what other investment, tax efficient investments that you could do, it's hard to say without knowing what your situations are. I mean, if you're saying that you've maxed out your pension contributions as well, so that means that you've maxed out your 40K annual allowance on your pensions. I'm assuming, James, that you're earning really, really well. And maybe you've done salary sacrifice or something like that into your pension to manage your tax position. Over and above those two things, I can't tell you anything without knowing more about what you are basically doing, because there's a ton of things that you could do, but most of them will require that you go and see a financial advisor, because you cannot just go and do them off the shelf under DIY. So things like EISs, VCTs, those kind of things, SEISs, are onshore bonds, offshore bonds may be appropriate for you. Those things you probably need to go take advice for. What I'm trying to say here is there are a number of things that you could do, but it's hard for me to be able to say, oh, just go and have a look at these things, because I don't know your circumstances. Now, with all things when it comes to investing, and it's really, really important to kind of remember, that at the end of the day, because your investing journey and what you want to achieve in your circumstances, everybody's circumstances will be different. It's like going into B&Q and knowing, right, for a particular job, there are like 25 tools. You then pick the one that is best suited to you. It's exactly the same thing when it comes to the investing side of things. Understanding, where you are in terms of the tax positions at the moment and what you might have available to you will really depend on what your goals are, because there are certain things that you can go into where you have to put the money in there and have the money in there for a period of time, but you're going to get a tax benefit from it. Some of it will be very, very high risk, but does the high risk that you have to take actually outweigh or counteract the fact that you're going to get a tax rebate in some way, shape, or form for that? It's quite an in-depth conversation. So really, you need to see like a professional who can actually sit there and say, okay, look, James, for your specific circumstances and where you are, having maxed out your pension contributions and your ISA allowance, this is the tool that will best suit you based on your goals and your objectives and where you essentially are. But there are a lot of choices out there, mate, that you could do. You have to weigh up the risks appropriately, and it depends on whether you actually need the tax back quickly or not, really, to be honest. So yeah. Right, where was I? Okay, here I am. Hi guys, find your channel really great and you've helped me a lot with your videos. I've just jumped into the live. It's like, is this a live Q&A? It is a live Q&A. I do this every Sunday evening at 8 p.m. So it allows people to basically come along, ask questions, and I can try and answer them as best as I possibly can. Hopefully give people, I guess, a piece of my mind in terms of how I would approach some of the things that people ask me about. The whole idea with these Q&As is not necessarily to tell you to go and do X, Y, Z, because there are so many variables. But what I do try to do is at least give you an insight to how I essentially would approach something and how I would actually think about it, so that you can hopefully take that and apply it in your own personal circumstances. But yeah, this happens every Sunday at 8 p.m. Ian, I was thinking 70 to 8% ETFs, S&P 500, and the rest in individual stocks. Pretty clued up. I would like to think, again, thank you. Not putting my lump sum in. That will be put away. Good. So look, mate. Ultimately, Ian, if you're happy with that level of risk, I mean, 70 to 80% in ETFs. Are you talking specifically the S&P 500? So all of the money going into the S&P 500 specifically. I mean, the only thing that I would say there is that is a US ETF. It's not global, but if you're happy with that, if you're happy with it, then by all means, then that could be the right thing for you. Um, but the S&P 500 really is a US index. Valak and I were talking about the inflation numbers and CPI numbers and what the Fed needs to do. We don't know whether the US market is going to be hit significantly as a result of interest rate hikes. If you're happy with that and you're happy with the way it might go, by all means, then the right thing. But if you're not, then it may be worthwhile just maybe having a look at maybe a global approach of some kind. But again, you've got to do what you feel is best for you in these kind of circumstances. Adrian, what do you think about Gazprom? Because of UK Russia situation, is it a good time to sell for 40% profit? I haven't tracked Gazprom myself. I don't own Gazprom, so I can't give you a definitive. This is how I would think about it personally. And I said this in the newsletter. I've said this on a couple of videos of the last maybe 2 or 3 weeks or so. If you're holding something right now and you're in profit and it's giving you cause for concern around some of the stuff that is going on, bearing in mind a lot of this stuff we have no control over. Putin could just decide, you know what, I've had enough of this nonsense. I'm going to invade. And if he does, then NATO gets involved, the UK get involved, the US gets involved. It's a mess. And then he diverts, oil through the pipelines, and we're all in a bit of a sticky wicket. If you're holding something at a profit right now, and that concerns you, and the thought of actually losing some of the profit that you've had kind of keeps you up at night, then you probably should take profit, mate, to be honest. I mean, one of the key things here is, we all talk about investing in the stock market and, holding individual stocks. And I've said this before, and it's really, really important that you have to know what might trigger you to make a move where actually, you know what, I'm going to take profits. You have to have an understanding of what that might actually be. Now, look, nothing might happen with Russia and Ukraine. We don't know. But the fact that you're asking this question means that maybe you're a little bit worried about it. And I guess the answer to the question is this. If you took profits right now, would you sleep better at night knowing that you've taken some off the table? Or does it make no difference to you whatsoever? If the answer to the first question is, yeah, Pete, I would sleep so much better knowing that I've got some money off the table and I'll leave some money in there, then that is the right thing for you to do. If it makes no difference at all and you're like, doesn't really matter, I'd love to see what happens, then maybe don't take profits. You have to do what you feel is right for you in any circumstance. So if you think, you've got good profit in there, you want to take some off the table, there's nothing wrong with it. Take some off the table as long as it helps you sleep better at night. Video to views, welcome. How you doing? Vic, great channel. I'm starting with a savings planning. Your videos have helped me a lot. Thank you. I make videos in this room. I record my podcast in this room. I write the magazine in this room. So a lot of the time, I have no way of knowing whether people find things useful or not. Well, certainly not from just gauging likes and views on YouTube. I think that's a really poor metric to whether you're doing a good job or whether people find things useful or not. As of late, it feels as though likes, views, and all that kind of stuff, as they kind of go down and fluctuate quite a bit, if I looked at those alone, it would be soul destroying because of the time and the effort and the work that goes into making videos. But it's comments like this that make it all the worthwhile, knowing that actually people do find benefit from it. And like I said, what I try to do in this channel is never really to kind of steer people in a particular direction, saying you should 100% do this, particularly when it comes to investing and stocks, because the real thing, the unfortunate thing about investing in stocks is A lot of the time we are guessing. We're trying to make the best guess possible with things like budgeting, um, basic money management, whether you should get a credit card or not, credit scores. Those things are actually quite more factual. Like, if you do this, we know that that's going to work. With the stock market, it's anyone to guess what's going to work, because we're speculating a lot of the time. So I try to maybe give people both sides of the coin. So thank you for this, Vic. I really do appreciate it. I have 500 to 600 pounds a month to invest for now. Other than the S&P 500 and other ETFs, is it wise to invest in REIT stocks to build my dividends? How would you structure this strategy? Well, I can't tell you how to structure the strategy, but I can tell you what my thought process is around REITs. So REITs can be good. REITs have to pay out um, their profits or their dividends, essentially. So they become a really, really nice bed for people who want to invest in real estate but don't necessarily have like large deposits to acquire portfolios on their own. There are different types of REITs though. So storage units have done very, very well over the last maybe 2-3 years. Storage units have done very, very well. If you had a REIT in with retail space like office blocks, they probably wouldn't have performed well because obviously the lockdown, pandemic, so on and so forth. Businesses looking at how they're going to operate moving forward. A lot of businesses not taking huge floor spaces anymore. So you've got to be very selective in terms of the type of REITs that you're going for. So make sure you do your research there. Um, it is a good way to build dividends if you pick out the right one. But ultimately, you need to think of it from, if you're thinking diversification. I mean, the S&P 500, everyone talks about the S&P 500. It's a really, really popular topic on YouTube because it's the top 500 companies in the world. They're all US. It is a US market. You have to think about the current circumstances right now. And Radek mentioned this earlier. You really have to kind of contextualize and think about how does what's happening right now potentially impact the decisions that I'm going to make. Now, we don't know what's going to happen to the US market, but we do know that there's going to be a lot of volatility and a lot of uncertainty. So when you weigh off that risk around, okay, so what happens worst case scenario if the markets in America do take a tank, take a big hit, and trust me, people will say that they don't, but they did. 2007, 2008, they took a massive, massive dump. If that happens again, are you diversified well enough? It all comes back to that one thought. People are buying S&P 500 because, yes, top 500 companies. Yes, absolutely. It's cheap if you're using the likes of Vanguard, so on and so forth. But you don't necessarily make money by putting all of your money into a particular fund of some kind. A lot of money is made and a lot of profits are made in the asset allocation. So, how you allocate your money to certain things. And if you're allocating your money to one thing, well, you're putting all of your egg in one basket. So, what I'm trying to say here is think about your asset allocation. If it's the S&P 500 and what else are you putting on the table? And how do you diversify that? That's really, really important. Yes, REITs may work as a way for you to build your dividends, but picking the right REIT as well is very, very, very important. So make sure you're doing your research on it as well. Is there anything apart from storage units in the REIT space that are done very, very well, or based on the economic circumstances that we're likely to face with high inflation and all this kind of stuff? Are there any other parts of the REIT kind of sphere that might do well off the back of what we're facing? Those are the kind of questions and the things to start researching. Someone's already done it for me. Don't forget to smash the like button, guys. Really do appreciate it. There's 80 people on here at the minute. We're at 35 likes. If we can get to, like, I don't know, let's maybe 45. That'll be amazing. Okay, there's a follow up here. My goal is to build passive income over the next 10 to 20 to 30 years and so on. Mate, again, with this, I'm not the best person to, I guess, to respond positively like most YouTubers who talk about passive income. So a lot of YouTubers and people on social media talk about passive income as this thing that gives you balance in life, so on and so forth. And absolutely it does. But if you're looking to build passive income now, dividends plays a part in that, but it's not the only game in town, if that makes any sense. So, and this is again where research comes into it. So you need passive income. Do you need it immediately, or do you need, from what you're saying here, you need it in the next 10 to 20 to 30 years time? So is the real goal here to have to build a portfolio that gives you a passive income in 30 years? If that is the case, and whether that's 30 years, 20 years, or 10 years, what really should be the focus is growth at this point in time. And that may include dividend stocks, REITs, so on and so forth. But it shouldn't be the main criteria. And a lot of people on YouTube will talk about, dividend stocks, this is how you're going to grow. No, well, and I said this, I think I said it on Thursday. If your selection criteria is purely dividend paying companies, you're going to pick up dividend paying companies, which is great. That ticks your box. But you would have missed out on a lot of really good companies that have performed extremely well over the last 24, maybe even 36 months. And whilst past performance is no indication of future performance, it just goes to show that people like Warren Buffett, for example, he doesn't pay dividends, but look at the returns on Berkshire Hathaway. Very, very well performing. Look at Tesla. They don't pay dividends, but look at the performance that they've enjoyed. The growth that they've enjoyed over the last 24 months. Phenomenal. Amazon. You can mention a lot of companies like that. So it's trying to reposition and maybe think about that goal. Passive income in 30 years, in 10 years, in 20 years' time, growth should be the priority. Some people will say have a look at total return. So look at the total return that you can get, and that includes dividends. But don't let the lens of selection purely be just dividends, I guess is what I'm trying to say there. Because REITs will do really, really well. And also just making sure that you're able to, within your plan and your strategy in terms of how you're going to get to that point where you've got enough in a pot, how are you going to monitor that in terms of what are your milestones, right? So, you want a passive income, but what passive income do you want? Is that $5,000 a month, $2,000 a month, $3,000 a month? What is that number? Think about that number, because the number becomes very, very important. Like really, really important, because that will inform the kind of things that you do now in order to make sure that you get there. And it gives you your milestones to check in to say, actually, by this point, I should be here. Well, the reality is I'm not, I'm behind. Or the reality is, oh my God, it's done so well, I'm ahead of myself. Those things, the details are very, very important. Victor saying, I think I used the Vanguard Life Strategy funds to save with the target of 4 to 8 years. I'm flexible with the geopolitical situation and the expected inflation. Should I learn more towards should I lean more towards shares? Well, the Life Strategy funds are invested in shares, mate. They're not invested in well, they do have bond exposure. If you're going for the 20, 40, 60, 80, you've got bond exposure, but all of those ETFs are invested in shares. I mean, you can lean more towards selecting your own shares if you know what you're doing in terms of how you're going to pick these companies and how you're going to spot the opportunities, then you can. But that's a different ball game to just putting money with a provider like Vanguard, who has done all of that work for you, and then packaged up a load of funds that they believe will do really, really well based on research. You leaning into shares to select them on your own, you need to have a really good understanding of what's going on and what the opportunity is within particular sectors. Yeah, you need to make sure that you know what you're doing in terms of the research, is what I would probably say there. I mean, it's high risk strategy, but high risk, high rewards in some cases, but it's 50-50. You could get it right, you could get it wrong. Who knows? Naeem, I've been lucky to rent a studio for £500 in London. Wow. Drawn a budget and doing my best to cut expenditure. What other ways to save money for property? Currently investing in Money Farm and Wealthify. Very good. Thanks. So, Wealthify is sponsoring the channel for the next few months. So it's good to hear someone actually using them as well. If you're already cutting expenses, mate, That's really, really good. You've already got a budget, so you're tight on that. You're cutting expenditure down. Other ways to save money. Um, Without seeing your budget, it's hard to know. I mean, I think what's your goal here? I mean, I don't know what your goal is, mate, but if you, one of the things that people often miss, and I think it is worthwhile thinking about it, is it's all very well and good controlling the money that you have coming in and going out. That's obviously a foundational piece. That's very, 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 very important. But actually, can you make more money? Because the beauty of it is, mate, and this is where you kind of get to a point where you have a moment of realization. If you're able to keep your expenses as low as possible, but you're able to increase how much money you have coming in, all of a sudden you find yourself in a completely different ball game, because that additional money that you have, and you need a little bit of discipline with this, it allows you to deploy it into things that you actually want to do. So if it is for property, for example, you getting the expenses down is going to serve you in a couple of ways. Number one, if you're able to increase your income, there's more money to go towards the house deposit. But ultimately, when you actually get round to applying for this property, it's going to do wonders for you when it comes to the affordability. And what I mean by that is the banks are going to stress test you when you apply for your property, right? They're going to want to know what you've got going out of your accounts. If you've got things like, personal loans and gym memberships and credit cards and all those types of things, that potentially, especially if it's a committed thing, right? So if it's a committed expenses like a credit card, personal loan, uh, car finance, those kind of things, you could walk in and be like, oh, you can lend £260,000, and I've seen it in situations where we've had a look at the personal loans, credit cards, car finance that they've got to pay. Then all of a sudden, that 260 is automatically 200,000, and then people realize, hang on a second, whoa! So that car that I've got that I'm paying 400, £500 a month for, basically means that I can't borrow £30,000 to get the house that I want. Really, 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 really staggering stuff. And people don't realize it until they actually get presented with that as, you've got this to pay. So therefore, our stress testing means that we will not lend you that 260, we'll lend you 200 because you've got that commitment as a car payment. And with interest rates increasing as well, they've got to be a little bit careful around that too. They don't want to put you in a position where, you're lending money via a mortgage, that potentially the cost of that could increase if interest rates increase quite dramatically. So, if you're already cutting the expenditure, fantastic. Is there anything you could do side hustle to just give you a little bit more income, to boost it a little bit more? Budgeting is the foundation to everything. I run a very, 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 very lean budget, um, but it means that I've got more disposable cash just to do whatever I want with, which is always nice. I love this question. No, it's mate. No, it is absolutely not. It really, really isn't. It might seem like it is, but it's not. 43 is not too late to start putting money into a pension. The beauty of it is, mate, like at the end of the day, small things over time with the compound interest really do add up. I mean, what's your retirement date going to be? We don't know at this point in time. But if you assume that I'm going to assume that you have zero right now. So really, you've got nothing to lose, to be fair. And I'm going to show you something on a compound interest calculator. And look, bearing in mind, it isn't going to include any um, fees that you might actually pay for an investment service or someone actually running the pension for you. It's not going to take into account any of that. And it's not going to give you I guess, guaranteed rate of return. So these are all hypotheticals, and we always talk about, on average, if you're able to achieve these kind of returns. But when you add this up over a period of time, it really does make a massive, massive difference. Now, let's just say, for example, let me just extend this over. Actually, one sec. Let's pull that over there. I'm gonna assume that you've got zero at this point in time, right? So you don't have anything in a pension at all, and you're literally just starting from scratch. So just bear in mind you've got nothing right now. So let's just say initial balance, you got zero within there. Let's just say you're able to achieve something like a 7% annual return on average, and this is being relatively conservative, I guess. Um, let's compound this on a yearly basis. And let's just say you're able to do something like, I don't know, 120. I'm just going to make these numbers up. What didn't this like? Oops, what? There's an issue with the information you submitted. What's wrong with what I've submitted? Oh, yeah, years. So you're 43 right now. Let's just say you wanted to retire at, say, age 16. You've got a 17-year term in there. From zero, that's £45,000 pretty much there, £46,000. And again, that's not going to include any fees that you've got to pay for investment services and all that kind of stuff. But bear in mind, you have nothing. If you did nothing and you have nothing right now, in 17 years' time, you will still have nothing. You can have potentially £45,000 by simply just using the compound interest calculator to extrapolate what it might be like in the future. Now, look, you can play around with numbers like this, and I always do encourage people to play around with numbers like this. You can be, very conservative. You could be really, really optimistic. If you were going to be optimistic and say you had, a 10% return average every single year, you know, that's £61,000, but it's still £61,000 that you don't have and you wouldn't have if you did nothing. So, it is never too late. It really, really is never too late to start taking action and doing something. And if you are in a business, you're working for an employer, then, make sure that you're enrolled in your workplace scheme, your auto enrollment, your workplace pension scheme, because at the end of the day, they, under the new rules, have to pay into a pension on your behalf. That's 3%. You pay in 5%. That's 8% automatically. You read books like The Richest Man in Babylon, and one of the key themes in that book is, if you want to be wealthy, try to put away 10% of what you earn. Well, if you look at pensions, that's 8% right there. If you're self-employed, I know that it's a little bit more tricky because you're worried about the business and running a business as an entity of its own. And a lot of energy goes into that. But as a business owner, you should always try to recognize the fact that, if you're running a limited company, a registered business, then something like a pension is an allowable expense. It is a business expense that can help you reduce things like your corporation tax. So there are benefits for you there to do that. But it's never, ever, ever too late, mate. And, I would really, really strongly encourage you, like, just start, and if you are in a workplace scheme, try and make sure that you're taking advantage of that as much as you possibly can. This is a really good question. How do you work out how long your pension will last? Right. Okay. This thing's not working. This would be a perfect way for me to actually illustrate this, because there are a lot of numbers in how I would explain the answer to this question. Bear with me 1 second. I need to see if I can actually get this to work, because it would be really useful for me to be able to demonstrate these numbers. Let's try this. Okay, it's thinking. This. Error. Okay, let's try this one more time. So the key thing that you need to think about when trying to answer this question is life expectancy. Okay, so, and this is why, and people give me stick for this. This is why I have an issue with the likes of things like the FIRE movement, because the general mantra within the FIRE movement is, from my experience, guys, okay, from me interacting with FIRE, this is what I get from it. It is about trying to be frugal at the moment, accumulate enough money so that you can retire early. Now, the idea of retiring early is attractive, but the biggest thing that I don't feel that they account for is income longevity, which is the question here, and how life expectancy impacts that income longevity. Now, the simple fact is, if you retire at, say, age 55, right, and you've got a life expectancy that's going to take you into the 85, even into your 90s, that means you need to have a large enough sum of money to last you for 30, 35 years. And people are living much, much longer. That's just the fact of the matter. I did a video very early on in the channel. I think my life expectancy is about 87 years old, right? That's my life expectancy. So people are living much, much longer. So if you retire at 55, you've got to have a large enough pot of money to last for 30 odd years. Now, if you look at the simple maths, right? So let's just say you need 20 grand to survive, and you're going to live for another 30 years. That's £600,000. If you're going to survive for another 35 years after you retire, that's £700,000. Now, most people will argue we are not funding our pension pots anywhere near as much as we should. How many people have got £700,000 in a pension pot right now? Now, the numbers seem very, very large, but the reality is very, very different. So if you're a married couple, for example, I already mentioned earlier things like state pension. As long as you qualify for full state pension, you've had the prerequisite number of national insurance contribution years, then a married couple will get probably between 18 and 19,000 pounds in state pension, which if you need 20 grand to survive is more than enough. But this is where the kicker is. Can most people survive on £20,000? Some people can, some people can't. And this is the biggest concern that we have. So I've worked for a pension provider for a number of years. And oftentimes when we speak with clients, would speak to them about what they want retirement to, what they want life in retirement to be. And oftentimes when people are asked that question, they reflect on it based on the life that they're living right now and the things that they're accustomed to right now. So for example, if you are living a life at the moment that affords you the ability to go on two or three really nice holidays a year, and you're driving a really, really nice car, it is very, very unlikely that you're going to want to get to retirement age and have to forego a nice car or forego potentially going on two or three really nice holidays. Okay, you might say, actually, you know what, I'd rather go on one or maybe two. That might be a sacrifice that people are willing to make. But people are very, very, very unwilling to make the kind of sacrifices where they're saying, actually, I don't want to drive a nice car. I just want to drive a small car. Or I don't want to go on, my nice holidays. I'd forego them altogether. And the reality is, when you think about how much two or three nice holidays actually cost per year, plus a nice car, being able to change your car on a regular interval and have the finance to sustain that kind of stuff, oftentimes it is more than £25,000 per year that people need to be able to do that. This is assuming they've paid off their mortgage. So this question about longevity is a very, 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 very difficult one. Now, people will talk about the 4% rule. So 4% of whatever you have in the pension pot should give you the income that you basically need. We've not even touched on things like inflation, by the way, because inflation is a really, really big factor when we talk about retirement income, because inflation is all about the fact that your 10K today is not going to be worth 10K in 10 years' time. So you have to factor in inflation even when you actually get to the point where you're taking your income. Because if you're taking, I don't know, £1,000 per month every single month, you're not going to be taking £10,000 a month in 10 years' time. You're going to have to bump that up to keep up with inflation. And so understanding how long your pension is going to last can be a really, really tricky one, because it is all about, number one, what do you want life in retirement to look like for you? And I always talk about planning backwards. So whenever I do consultations with people, I'm working with people on a one-on-one basis, we're looking forward to work backwards. Because if we know it's 2-3 holidays, really nice holidays a year, it's a really, really nice car on the drive because that's what you like, and you want to be able to go playing golf, or you want to go for spa days, all of that costs money. So understanding what that costs from an annual point of view, working backwards to a pension pot, is the most important planning step that you have to take. And in my experience, FIRE misses a lot of that out. It's sexy and it's attractive to think about retiring early, but what's the practicality behind it? How does it actually work? The reality is that there are a lot of people who have got pension pots at the moment that don't have enough in there to basically sustain them for the entire time that they're going to be alive for. That is the reality. We have a huge, huge underfunding pension problem here in this country. And the reality is, there is a fear that come 10, 15, 20 years time, the state pension isn't going to be around. So in this example I've talked about, you might need 20 grand and you can get 18 to 19K from the state pension. That might get pulled in 15, 20 years' time. Then what? The government has laid the groundwork for people to take ownership of their own pension provisions by introducing auto enrollment back in 2014, 2015, where they made it compulsory for your employers to pay into a pension on your behalf. That was not done out of, this will be a good thing to do. It was done for a very specific reason. They know that they cannot continue to keep up with state pension. And the state pension is essentially, if you think about an ATM, a state pension is essentially an ATM. Now, how the state pension works is this: everyone who's in the working population right now is the person putting the money into the ATM, right? So everybody who's paying taxes just pumping money into the ATM. That's at the back of the ATM. At the front of the ATM taking out money are pensioners, right? They're taking money out. But everybody who's working right now paying tax is replenishing that money. Now, what we are facing in this country is people living much, much longer in retirement. We don't really have a really a balance in the population in terms of tax being paid into the system. They know that this isn't sustainable. So inevitably, you're going to get to a position where there's not going to be enough people putting money into the ATM to sustain the people taking money out of the ATM. And then this is the tricky bit, because when the government does finally decide that actually this is unsustainable, we're going to turn off the taps, remember, everyone who's paying taxes right now is paying the state pension for everyone who's retiring right now. When you get to your turn coming to the front of that ATM and they've turned off the tap because there's not enough people paying taxes to fill it up in the back end, you're going to feel a certain way. It's going to be a very, very interesting political call. I don't know what party is going to have the cojones to make that call, but it is something that has been spoken about in the industry for a very, very, very long time. The state pension, as it currently sits, is not sustainable. The government knows this. And so this is a very, very interesting conversation. And all I can say is, we have to take ownership for our own contributions and our own pension provisions right now. We have to. The government has laid the groundwork for us, given us incentives, the tax reliefs, all that kind of stuff. That's all for a reason. It's all for a reason. We have to take ownership of it ourselves. We can't rely on the government to be able to do that. So how long will it last? It really depends on what your retirement picture looks like. What do you want it to be like? How much income are you going to need? Your pension pot of £500,000, if you have £500,000, is going to last longer if you only need 10K versus if you need 30K a year. If you're just doing the simple maths and not factoring in investment returns, because obviously a pension is also invested whilst you're taking your income, which is great because you've got the potential for it to grow, but you've also got the potential for, when markets are volatile, for it to drop. And then you talk about, okay, so what happens when the markets drop and you're taking 20K from your pension pot? Do you then 1 year have to take 15K? These are real conversations, and it takes professional management. It really takes careful planning to get this right. And unfortunately, not everybody gets it right. It's a really long-winded question, but I love pensions. I'm very, very passionate about pensions. I can talk about this stuff all day. It's very, very interesting to me. So there's a follow-up here from Nav. While Life Strategy UK are UK tilted as compared to the share of the UK economy 4%, is weighted in the funds is 19%. I think I've just covered that earlier. It's not UK weighted. The top holding at 19.7% is a UK thing, but the overall exposure in that Life Strategy Fund 100 is tilted more towards the US, because it has over 40% exposure to the US market. So it's not UK tilted. This might be a weird one, but how will everything be affected if Russia decides to go into war with the world? God forbid if that happens. Do investors sell everything right away? I can guarantee you right now, not all investors will sell everything. It really depends on what you're invested in and how anything that Russia might do could impact markets. Because, there's a war, and, look, we don't know what he's going to do. Maybe people are saying he's posturing. is he really mad enough to invade Ukraine, knowing that NATO would have to respond and the US would have to respond? I don't know that he is. I think this is very much posturing and trying to take a really, really strong stance, letting people know I'm willing to go to this length if you allow Ukraine to join NATO. I think that that's what he's doing. If it did go to war, there's a whole host of things that could potentially happen. I mean, just diverting, gas and all that kind of stuff. It's just that's tip of the iceberg, really, from what most people would argue. But how that would impact markets, it will have a negative impact on markets, but that doesn't necessarily mean that there won't be any opportunities within that as well. So I don't think that investors will sell everything just because there's a potential war with Russia and everybody has to pile in. People will still find opportunities in there. And I'm sure that there will be very, very clever analysts that will be looking at that right now, looking at contingencies, saying, well, if Russia does go to war, they do it, and the US responds, NATO responds, and everybody piles in. Where's the opportunity to make money? Because there will be an opportunity. Unfortunately, I don't have access to research teams anymore to be able to give any kind of insight in terms of some of the things that people would be looking at, but there will be opportunities. Whether retail investors will be able to spot those opportunities straight off the bat and take positions. I mean, look, most people who are looking at this right now, if they're going to be taking positions, will probably be taking positions right now under the assumption or the probability that it could go south. And taking the position early is where the real gains are. By the time you hear about it in the news, it's probably already too late. If anyone's taken a position early, they've made a ton of money by the time it hits the news. So I don't think it's a case of everybody will sell everything. I don't think that will be the case at all. People will still be invested in the markets 100%. It's just a case of how does it impact the investment portfolios. And again, this is why global diversification is so important, because you wouldn't want to be invested in something that has a greater exposure to something like this going south and then detriment happening or being a byproduct of what happens. But again, with all things when it comes to investing, it's always a risk. Capital is always at risk, which is why informed decisions are so important. It's not about guesswork. It has to be informed decisions. And that's why the likes of investment houses, where you're actually paying somebody to do something on your behalf, that's where they earn their money. In situations where markets are volatile and there's a lot of uncertainty in the markets, that's where they earn their money, because they will have teams researching things. They will have access to information and data streams that retail investors won't necessarily have. So if they're managing things on your behalf, they're making calls based on research, based on what they're seeing, based on noises, based on things that you won't hear until it hits the news and it's too late. And that's the benefit of using some of these companies like Wealthify and others, where they are, that's their job, that's their level of expertise, that's where they're focused on making sure that they can build portfolios that could, number one, stand the test of volatility and all this kind of economic geopolitical stuff, and still be in a position where it can make money and not lose money. So look at this. If you receive a deposit of, say, 10,000 into your holding company account from a friend, do you have to pay tax on it? 10 grand for what, mate? Into your holding company. So I'm guessing you're talking limited company here, right? I mean, so if you're receiving 10 grand into a company account, it will be classed as turnover. So that will be, you're gonna have to pay corporation tax on it for sure. Yeah. Yeah, you would have to pay corporation tax on it, because your turnovers, well, your profits will be taxed, I should say. Your profits will be taxed. So if you don't spend the money in business expenses, then yeah, you're going to pay tax on it. But yeah, it's hard to say without really knowing the full picture. What you getting 10 grand for, mate? What service are you rendering? What are you actually doing? Is it a gift? If it's a gift, that's a very good friend that you've got there, mate. I've done it. All right, let's go into Sam. I have 250K in a trust and I'm questioning what to do. I have a young family and want to buy our first home, which is going to be between 750 and 1.2 million with an annual income circa 200,000. However, as a 18-year-old, I got bad credit. Do we A, invest the funds while we build our credit, B, buy a flat for cash to rent out while we build our credit up, or C, because of our loans of a deposit, is, let's have a look, is there a way to buy our forever home for 750? Okay, this is a really good question, mate. So if you've got an income circa 200,000 pounds, I would be asking what's wrong with your credit, what's on your credit. I mean, the reality is, look, you've got to apply for a mortgage, but with mortgages, the mortgage companies will score you very differently with a mortgage than if, for example, you're applying for a personal loan. It's secured debt versus unsecured debt. A mortgage is a secured debt. So if push comes to shove, you can't pay this mortgage, they will basically just repossess the house. It's in all of the disclaimers that they give you, right? They're very, very strict on making sure that you understand that that's what potentially happens. So I'd want to know what's wrong with your credit, because you have bad credit doesn't mean that you're not going to get accepted by a mortgage lender. There will be people who will look at for you. The trade-off is, well, you might pay a little bit more in terms of the mortgage rate, but you'll get the house. Now, multiples. You've got a deposit, you've got a large deposit, mate. I mean, if you just go by standard multiples, I don't know what you do. Um, I don't know what you do, but you could potentially apply for a mortgage with a higher multiple that will get you there, although you might not actually need it. But if you go on a multiple of times four, that's 800 grand immediately right there. You've got 250. You're there or thereabouts. You're there or thereabouts. You would be a perfect person to sit down and do some coaching with, to actually structure this out, to actually have a look at all of the options, have a look at your credit report, see what's on there, see if there's anything that is going to be catastrophic to your mortgage application. Because sometimes it's not as bad as you think it will be, but you need someone just to have a look at it who kind of understands how these things work. I'm also a qualified mortgage advisor. I advise on mortgages for a period of time, so I can definitely view it from a lender's lens as well, to give you an eyesight into that, and then outline what your options are. Now, obviously, it's all dependent on application, right? So we can have a look at it on paper and be like, is this likely to derail everything? The great thing is you can do soft searches now, which is great, where there's no impact on your credit score. You can get an agreement in principle. Generally speaking, if you get an agreement in principle and you've had a good look at what they're going to be looking at on your credit report, and you can square away anything that doesn't seem right, as long as there's nothing that's really, really bad, you should be fine, mate. So the options there, you could get the house already. I mean, it's really about what you want. I mean, if you've got, it really depends on what you want, mate. It really depends on your circumstances and what you actually want. The danger of waiting is house prices increase. You need a large deposit, or that you've got a decent deposit there sat within the trust. If you go and buy a property and rent that out, that's money tied up. That's money tied. Yes, it's going to give you a rental yield, but it's money tied up. How are you going to release that equity? You might have to wait a little bit longer, at which point interest rates might have gone up, at which point property prices have also gone up. It would be worthwhile sitting down just to have a look at, right, what's the scenario, what's the situation, and then doing a pros and cons and saying, right, so based on what we know, this is kind of what we know from this point of view, these are the possible outcomes, and then decipher and almost funnel down to a preferred route of action for you. It's hard for me to give you real specific details, mate, without knowing more, but I would, just reading that, I don't think it's going to be as bad as you think, mate. I really, really don't. I genuinely don't think that it's going to be as bad as you think. I think you're probably going to be in a position where you could actually get the house, and maybe you're just worried that what's on your credit score would derail you, when it probably won't. It probably won't derail you. It's just knowing what they're likely to think based on the information that they are going to see, and looking at all the options that you have to make an informed decision of, okay, one of two routes. What do you want to do? What do you want to do? Where do you want to go? This is a follow-up from James. Appreciate it. For some reason, I thought lifetime ISAs are somehow separate to general ISA allowance. Love the channel. Had a suspicion an FA might be the next port of call. Yes, mate. Yeah, go speak to a financial advisor. If you need to speak to one, you don't know any, then just drop me a message. Peter conversationofmoney.com. Also, Sam, if you do want to have a little chat with me, what I would maybe suggest you to do is book a discovery call with me. If you go onto my website, you can book a discovery call there. Discovery call is a free half an hour consultation. We can have a look at it high level, and I can then ask some very specific questions to kind of get an idea of, okay, so is it worthwhile waiting or not? Or could you possibly go down the route of exploring all the options? It's free, it's half an hour. If you go onto the website, you'll be able to book there, or on Instagram. If you follow me on Instagram, it's in my link tree. You can book a discovery call there. But yeah, it's a free half hour. It allows us to talk. But yeah, James, if you want introduction to one that will do a good job, I can also help there as well. So just message me, peter@conversationofmoney.com. What's the best investment tool to use for money inherited? Okay, money inherited investment tool. I'm pausing because there is so much to consider when it comes to money inherited. I mean, look, my question to you is going to be this. And funny enough, I had a coaching call with someone literally on Friday who inherited money from an uncle. And the first thing I wanted to know, and I want to know this from you as well, Jacqueline, is what difference is this money going to make to you? And what do you want to use it for? Because a lot of people talk about, I've received this money, I've got to invest it. Sometimes investing it isn't the right thing to do. Right. So, for example, coaching client on Friday, money from an estranged husband, uncle, money comes in, money sat in an account right now. When we started talking about what she wants to get on the property ladder. She needs a deposit. Okay, so what does that look like? Is that in 3 years, 2 years, 1 year, 5 years? What is the timescale for that? Right, she's got certain things going on right now. It turns out, okay, it's not right now. It's not immediately. It's going to be in the near future. She needs to sort some things out with work for the multiple, so on and so forth. So we're like, okay, cool. You don't want to jeopardize your ability to get on the property ladder in the near future by putting a load of money into the stock market, and then we have a market correction. It takes 5 to 7 years for it to recover. So actually, the course of action is not to invest, it's to put it somewhere else, safeguard it. We then start to boil down around, okay, what does this actually money mean to you? What was your uncle like? So on and so forth. Her uncle was a traveler. She likes traveling. Actually, poetically, it would be amazing if she actually used some of the money to see the world like her uncle. Her uncle probably would have wanted her to do that. So actually, it's not about investing what's left. It's about actually taking a portion of that money. I need to change my battery. It's about taking a portion of that money and actually using it to travel the world, form a bucket list, and, enjoy, live life, gain experiences of some kind, right? So that's my question to you. What does that money actually mean to you? Because it may not be a case of investing it. Yes, you can invest it. And yes, there are plenty of things that you can do, and plenty of places that you can go and things that you could invest in. But what is the right thing for you to do with that money? Once we know what the answer to those things are, then we can get into the nitty gritty of, okay, so should you be looking to invest in this place, that place, or should you be using providers? Should you be doing it yourself? Should you be picking individual stocks? Should you just go and park this money in something that actually isn't invested, but you know that the money is there because it's earmarked for something in the future? Money is a tool. Life is for living. If you've inherited money, you probably have a sense of, you feel a heavy responsibility to use that money correctly. Because of social media, using money correctly means, in most cases, I should be investing it. It doesn't mean it's the right thing for you to do. So I would ask yourself those questions that I've just asked you there, write down answers to all of them, and then everything will become clear. If after you've written down all of the answers to those questions, you then like, okay, I still want to invest, then maybe book a discovery call with me, then we can have a look at maybe some of the options that are there, because it is all about how you invest. It's whether you want to do it yourself. It's whether you have the time to do it yourself. It's whether you want to go pick, some ETFs with Vanguard or whoever. It's whether or not you have the patience and the time and the know-how to do that. It's a question of whether, if you don't want to do that, whether you should be using a provider like Wealthify, for example, to help you invest it. The options are numerous. It's like, again, walk into B&Q, so many tools to do so many different jobs. We need to identify the job and identify the right tool. That's the most important thing. All right. So long-winded question, but I've thrown some questions at you, which I think are fundamental to understanding what your next step should be. Okay. So this is a follow-on question from the holding account question earlier. Is it the best way to keep your money in a holding account or personal savings account if you transfer most of your savings to your holding company account? Is it protected in cash in case of debt? I'm not sure I understand what you mean there, mate. So when you say your holding account, I'm assuming you mean a business account. Now, if you take money from a business account and pay it into your personal account, then essentially that is classed as income, which is taxable. So really, mate, you need an accountant to walk you through this, because that's a tax question specifically. If you're going from holding company account into personal account, well, that's a business transaction. If you're not providing a service for the amount that you transfer from your business to your personal account, i.e., you're not invoicing for a service, well, that's income which needs to be taxed and should be taxed accordingly. So you just can't go from limited company to personal account. You have to do it in certain ways. But directors will do dividends, for example, sometimes because it's easier and it's a lot more tax efficient to do dividend payments as opposed to just a transfer over. So really, you need an accountant to be able to look at this and find out what the best tax efficient way for you to get 10 grand from your business account is to your personal account, because you just can't move money around without thinking about the tax position properly. One second, guys. All right. Okay. Right. Let me just scroll and see how many questions I've got. So I've still got quite a few. Where are we? We are an hour 38 minutes in. Let's see if I can actually just fire through a ton of these really, really quickly. Um, all right, listen. So I've just scanned and just seen stuff. Kieran, if you're not finding value, you shouldn't be wasting your Sunday evening watching this live stream. Like, seriously. I mean, you're saying here I don't answer questions half the time. I answer the questions as I receive them. If someone super chats, then I will sometimes actually make a point of answering that. But there are a lot of questions here. It's only me. I want to make sure that if I get to a question, I try and answer it as much as possible. But honestly speaking, if you're here to complain, you're spending your Sunday evening like really poorly. You must have better things to go and do. Like, seriously, mate. Like, be kind to yourself and be kind to your time, and be respectful of your own time as well. Is it a good idea to hold off paying into a SIPP so that you still have access to money, but then paying in larger amounts in the years running up to retirement? Good question. I had this question, I think, on Thursday. So obviously, with a pension, your access to your pension under current legislation, you can't access it until 55, right? So for some people, that puts people off, because if you need, or if you think you're going to need money sooner than 55, it can be a big deciding factor. Um, Paying larger amounts of money in later years is fine as a concept, as an idea, but you're doing it in later years. And the issue with that is you're missing out on the time invested in the markets under the pension wrapper to accumulate for things like tax-free cash that I spoke about a bit earlier on. So whilst it could work and it could be something that would work for you, the thing that you're missing out on is the investment time of having that money invested 10 years, 5 years, 8 years prior. So it could work, but maybe it's not the most efficient way of actually doing it. And again, when you say larger amounts into your pension, you've got 40K annual allowance for your pensions and stuff, but it is based on earnings and everything as well. So how much can you really throw in? Eh, What I would say to this is, again, planning. All right, so forward planning. What do you need in income, or what kind of income do you want in retirement to be able to work back to how much you should be putting in right now? I think when you're clear on that, that will trump the conversation, or at least bring into balance the conversation of, right, do I need the money early, or do I not mind, based on the fact that I want that level, I want that kind of retirement, to sacrifice and to know that actually, you know what, I'm okay with not being able to access it until I'm 55. What do I think about precious metals, and how long would you save before you liquidate? Precious metals are good. I mean, gold is a really good diversifier, as has always been a good diversifier for especially volatile moments like this and where markets kind of trail off. Um, how long would I save for before liquidating? I can't tell you, mate, because it really depends on what's going on at any given time. You hold gold for a purpose, right? So if you're holding gold for a period of volatility because you think the markets are going to crash, if you've got a good portion of your money in gold, but then you then see a scenario where the markets are likely going to, or they feel as though that they're taking off again, then you might decide that you liquidate what you have in gold or palladium or platinum or whatever precious metal that you have over a period of time, as you feel maybe the stock market is going to recover or the markets are going to rally again. It really depends on your circumstances, really. Um, but yeah, I mean, that isn't to say go and do that specifically, but that's just a hypothetical there. But you would judge it based on what's going on and based on what you feel the markets are going to do, and based on maybe some of the information that you're that you're privy to. Wish I'd listened to you. Just invested in ETF or index fund. Ah, okay. You've put on here. So I was wondering whether this was going to be one of hindsight. I mean, look, hindsight is great, and I'm not the kind of person to kind of be like, oh, lessons learned and all that kind of stuff. But a lot of stuff that I talk about here on this channel is not sexy. It isn't, and it's not designed to be sexy. I can only tell people what I've come to know and understand from being in my industry for a long time. That's the only thing I can do. I can't do anything more than that. I'm not here to paint a rosy picture for people, and I'm not going to make things up and lie and make things out to be better than they actually are. I'm very much about steady Eddie. This is really my approach. There are lots of other channels that will talk about, and people are still doing it now. Open this position and all that kind of stuff. Now that's more trading than investing, and this is the thing: trading and investing are two different things, very, very different things. Like, there are channels that are talking about, to open in positions. Like, if you're opening a position, just make sure you know what you're doing. You can make a lot of money in it, absolutely. But that's not what I do here on this channel. I talk about investing and the theories around investing, the principles around investing, the fundamentals around investing, so that people can make an informed decision. Learning sometimes through I made a loss, that's only going to help you in terms of experience. You know what to look out for next time. So it's not necessarily something you should be like, oh, I regret doing that, and look back at it with shame or regret. No, it's a learning curve, and you learn from mistakes. At the end of the day, it adds to your experience. I've made a ton of mistakes. I still make mistakes now within my personal portfolio. That's natural. We're all humans. We're not perfect. So these kind of things, it's steady Eddie. And I'm not going to ever, make something out to be better than it is just for likes and views. That's really isn't what it's about. This is a good question. How do you identify a storage unit REIT in Vanguard? To be honest, I haven't had a look at any of those in Vanguard. I don't even know if they've got any in Vanguard, if I'm completely honest. But if they do have something that will be in the storage kind of like arena, you should find it in whatever fund objectives or anything like that. You have to read the documentation of whatever it is that you're looking at, because it will tell you what it's invested in specifically. Oh dear. Richard, mate, listen, if ever I'm in your area, I'll buy you a beer. I don't understand why people come on the internet and then try to troll. It's like, we're not talking about anything like controversial here on this channel. It's not like I'm part of like the red pill, blue pill community where there are going to be vehement opposing views on the topic at hand. Like, this is fairly factual, fundamental stuff, right? The markets are the way they are. Yes, it's very subjective, but the fundamental principles are pretty much exactly the same. Like, if you're watching a live stream and I'm not getting around to your question like quick enough, if you've asked a question, Kieran, like, may I remind you first and foremost, I've given up an hour 46 minutes of my time tonight for free to educate and inform people. Like, you're in a queue of people asking questions. People are waiting patiently. You know, I'm not charging people for this. And I do this every single week, by the way. And I've almost be coming up to a year doing this. Like, prior to this, was anybody in the investment space, in the investing space on YouTube doing live Q&As like this in the UK? I don't know of any, especially none that have the qualifications that I have and the experience that I have. So if you don't like what you're seeing and what you're listening to, mate, go find something else to do. Like, it's very, very simple. Like, you shouldn't waste your time watching something that is either going to anger you, frustrate you, and make you feel uncomfortable. I don't get why people waste their time doing these kind of things. It's just, and you got to think about the kind of person you want to be. Are you the kind of person who wants to really take your frustration out on someone on the internet? You don't know me. I don't know you. You're making a judgment in the comments that is really unfounded. Maybe because you had a bad day. Do you really want to be that kind of person? Like, seriously, is it really worth it? But anyway, Richard, thank you, mate. Oh my god, there's so many more. Hey, Kevin's on here. Kevin, dude, I've not seen you or heard from you in ages, ages and ages and ages. I hope you're well, mate. Um, right. So your question on here, and thanks for the super chat, is if there's any benefits to of having a trust. So if you have a trust, and I think you have got one, mate. So the whole point of a trust is to basically have money in a forum or in an environment where the express wishes for the purpose of that money are made clear, and it basically governs how that money is essentially used according to the wishes of that trust. Can be very, very beneficial if there are health issues, or if money's being left to a family member, a large amount of money is being left to a family member, and maybe people just want a little bit more control around how either the money is sent to people, how people receive the money. They want more control over it. It can be very, very tax efficient as well. There are some great tax benefits to a trust, which is why a lot of people, wealthy people, will use trust to pass money down to kids and beneficiaries. So yeah, there are some really, really good benefits on there. I think for you, because I know that you do have one, although I don't know the full circumstances around it. And it depends on what kind of trust you have as well, because there are different kinds. There are bare trusts, which will be like the wishes are set and that's it. Once they're set, they can't be changed. But then you have things like discretionary trusts, which they can be flexible. They can change the instructions on the trust at any given time, and it can flex and give. It really depends on what kind of trust you have. But one of the main benefits and the reasons why people use trust is because, number one, control over how the proceeds of that trust or whatever sits in the trust is then given to beneficiaries, and tax. Tax is a big thing within trust as well. Mate, it's so good to know that you're actually still about, mate. So cheers for the super chat. Um, there's a mortgage question here, and this is from Jacqueline actually. Um, okay, Jacqueline. So you were talking about the inherited money here. So let me just get to this quickly. So you're saying at the moment financially stable. You've only got 2 years left on the mortgage. Have 17 years in a workplace scheme. Okay, so for you then, it's a question of lifestyle. What does that general thing look like? If you've got 2 years left on the mortgage, I mean, I don't know how old you are. You look relatively young, just by what I can see on your thumbnail here. It's all going to be about using that money, but to perhaps create a balance in life that is going to give you the freedom of choice around what you essentially do. Investing can definitely help with that. The other barrage of questions that I asked at the back end of that previous monologue, if you will, is deciding how you're going to invest that money. Are you confident to do it on your own? How do you want to do it? Do you want to be DIY? Do you want to pick stocks yourself? Do you want to go into an index fund? Do you want to go into ETFs? Do you understand the risk that's involved with that? Or do you just want to hand it off to somebody to do it for you? Those are the next round of questions really that come into play. Again, you can feel free to book a 30-minute call with me, and I can run through some very, very high level stuff with you. So feel free to do that if you want to, Jacqueline. Okay, I'm just trying to go back up to to where I was. I'm completely lost in the comments, and we're now an hour 52. Oh dear. All right, listen, everybody, just leave Kieran alone. Leave Kieran alone. Bless him. He's having a really bad day. Um, he's having a really bad day. Let me just honestly, if you're still watching, it's amazing though. If you're actually still watching, it is actually quite amazing. Like, you're hating the live, but you're still here anyway. I mean, I'll applaud you for that. But hey, it's one of the situations, mate. Like, seriously, go and have a beer or something like that. Really. Okay, so look, we're an hour 52. Look, guys, how come my question keeps disappearing? What's your question, Abdul? I can't see it here. I've got so many that I haven't been able to get to. There's a question on here about Shiba Inu. I think Radix probably answered that. I don't know though. Um, okay, I'm going to take two more. I'm going to take two more questions. I just found where I was. Aha. Okay. Cool. So Radix just messaged me here. Abdul's question was: are there any other asset classes you would recommend to dabble into? Thanks, bud. Okay. Cool. Abdul, sorry, mate, I can't see your question on here. You're in here in lost, but basically, so asset classes. What are asset classes? So asset classes, you've got equities. Equities are mainly the engine for your investment returns. That's where the stocks, shares, equities, that's one asset class right there. That's the predominant one that most people are invested in, right? So if you're trading 212, free trade, whoever, you're buying equities. Other asset classes, you've got bonds, right? So within bonds, you've got corporate bonds, you got corporate bonds, you got government bonds, so gilts, right? So that's an asset class right there. You have property, which is an asset class. So again, things like REITs, for example, will fit within that asset class bracket. You've also got things like commodities, which will be your oils, your gold will fit within that as well, silver, so on and so forth, that will fit in there as well. You could possibly have a look at money market funds as well. That's another asset class potentially. With money market funds, they're pretty much as close as you could get to cash, really, to be fair. So those are the most popular asset classes there are, that you can invest in as an investor. Now, I cover this in my course where I talk about, depending on how you want to invest in your risk profile, how does your typical investment portfolio look like? What does it look like? How do you weight to equities, to property, to commodities, to, I don't know, money market funds if you wanted them as well? That is all depending on what your risk profile is, or the risk that you're willing and able to take. So those are just some there, Abdul. Sorry, I didn't see it, but Ralix pointed out to me there. I'm going to pick one more. There is one on here that was a mortgage question. Okay, so this is it. This is it from Abigail. Have you heard of don't invest money you'll need in the next 5 years? I'm saving for a house deposit to use in the next 2 years, and I'm currently separating it from my investments. Is this best? Yes, it is. Now, a lot of people, I know a lot of people who watch me, who listen to the podcast, who watch me on Instagram. I know a lot of them, an awful lot of people are trying to invest money to aid in a house deposit, to get them further down the line to be able to get that house deposit. And I completely appreciate the challenges that people have with, increasing property prices, therefore larger deposits. But what you've heard is correct. Look, if you're looking to invest in the markets, the general rule of thumb is really you need to be thinking long term. And most people will start to think about long term being at least 5 years. If you're looking to buy a property in the next 2 years, then you're potentially taking too much risk if you're going into the markets, particularly now with it being very, very volatile, and particularly with there potentially going to be all of these rate increases that could mean further volatility within the market. The last thing you want is to be putting 10 grand, which is going to be needed for your house deposit, into the markets, then the markets fall off. And, from the last time we knew that there was a massive market crash in 2007, 2008, it took 5 to 7 years to return. You don't want that. You can't afford that. And I speak about this in this month's episode of the Convo, the magazine. Can your goals afford to wait? Can you afford to wait if the markets were to crash? So the prudent thing is not to invest that money. Now, what I generally say to people is this, if you've got a lifetime ISA, you're putting money into a lifetime ISA, all right, you can only put £4,000 in there, but you're going to get £1,000 free from the government. That's a 25% return. That's a good enough return to help you towards your house deposit. It's better to do that, so to pay money into a cash lifetime ISA, than risk putting it into the markets on a 50-50 chance that you could potentially make more money that will help you towards your deposit, but at the same time, the markets could take a dive and you lose part of your deposit money. So playing it safe, being pragmatic, putting it into things like, using your lifetime ISAs, maximizing those, and not taking that level of risk. That, like, the goal is not to get better investment returns. The goal is to buy a house. And if you can keep your eye on the house, investment returns don't really mean anything at all, because it might take you a little bit more. And I know it can be frustrating, and I know that sometimes it's uncomfortable to take on board, but you don't want to risk that money going into the markets with the markets being as volatile. So yes, it is best not to invest money that you're saving for a house deposit, especially if it's within the next 2 years like you are here. So yeah. All right. Okay, cool, guys. So I'm sorry, I can't get to all of the questions, but I've given it as much as I possibly can in terms of time. This will be my first 2-hour stream by the time this is all done. And I know that there are still a shed load of questions on here and comments that I've not got to. But next week we will be here again on Sunday next week. Like I said, I will always try to answer the questions as I see them in the chat. If you super chat, I will get to those because you're contributing, so it's only right that I actually try and get to those a bit quicker. But I appreciate every single one of you for sticking with me for the last 2 hours. Whatever it is that you're doing next week, have an amazing time. I've got a really, really busy and exciting week ahead. Everything that I couldn't do last week because we have COVID. I had COVID, I should say. I'm going to do this week. And the next couple of weeks are absolutely jam-packed. Hopefully, I'm going to be able to provide and bring you some behind-the-scenes footage of the whole filming for Channel 4. I've actually got a script and everything I need to review here. I've got a request to actually, I've got something to do with a book right here, my book. So there's a lot of stuff, exciting stuff going on. I will be doing these lives. If I can't do a live, or it needs to be pulled up a little bit earlier, maybe 7 o'clock, because I'm traveling quite a bit over the next couple of weeks, I will let you know midweek. But guys, have an amazing week. Thank you so much for being here. I appreciate every single one of you. And thank you for the super chats as well. Have an amazing week. The podcast episode tomorrow morning is amazing, especially if you're looking to change jobs, you're going to be attending an interview of some kind, or you know someone who's looking to change jobs. I have a Marie Celeste. She's here on YouTube as well. Go and check her out. She's an interview coach. She's got 10 years experience. She's interviewed 4,000 people, dropping absolute gems. It's not just about being good at the interview. It's also about negotiating a really good salary as well. So that's on the podcast tomorrow morning. As always, guys, I'll let you go. Catch you in a bit. Cheers. Bye.